Well, NVIDIA is a big story south of the border. On this side of the border, earnings from Royal Bank of Canada and Canadian Imperial Bank of Commerce have dominated investors' attention. To further break down the numbers and get his view on the bank stocks more generally, let's bring in Tony Ciero. He's president and senior portfolio manager at Caldwell Securities. Tony, thanks for coming by.
Thank you, Paul.
Let's start with Royal Bank of Canada. That stock's down about 3%. It was a narrow earnings miss, but a miss nonetheless.
Absolutely, and 3% down has wiped away its year-to-date returns, but over last year, it's still performing quite well. And we have to look at the loan loss provisions, and definitely higher than anticipated, and that just takes away from the bottom line. But when you consider the loan loss provisions, there's always two parts to that story. There's the impaired loan, so the first side is the impaired loan, and that actually went lower. And those are loans on the books that are already gone defunct. The second part is this performance loans. And those are...
performing loans.
Performing loans,
right.
Correct, yes. And those are loans where the client is still paying on time, but you expect down the road that they're going to go into default. And setting aside $568 million, to put that in perspective, last quarter was only $68 million they set aside. So that's a big increase. So do they think that we're going to have an economic slowdown going forward because of tariffs?
So I've asked this question to other guests as well. That big increase in the provision for performing loans, loans that are still being paid on time, does that not suggest that potentially in the future some of that money, a lot of it, may come off out of the provisions back into profit, giving a bit of a push to earnings?
Yes, and that's a great question. That's exactly what we've seen the banks do in the past. They overestimate sometimes and then bring it back by the fourth quarter. So this is just second quarter earnings. By Q4, potentially we see that back to the bottom line, and then you have a nice pop in the stock. So our view on Royal Bank today is a great buying opportunity, especially when it's down 3%.
Is it counterintuitive that the banks have rallied so much since the first week of April or so, and now in this reporting season have expressed some concern about the state of their borrowers?
Yeah, there is. Like, what's there down the road that can lead to this? And tariffs is a big concern, especially when it comes to global growth. So I think they're just being cautious. CIBC, which we'll talk in a bit, only put about $50 million aside, more than last quarter, towards these performing loans. But the Royal Bank, again, when they put in $500 million aside, they think there'll be a slowdown. But again, that could come back to the bottom line near the end of the year.
Okay, let's talk about CIBC. The market, actually, the last glimpse we had of that stock, it was down very, very slightly, but it exceeded expectations by a pretty wide margin today on an earnings per share basis.
Yeah, and you have to look right at the capital markets division and the volatility in the markets that we saw in March and April. Remember when tariffs were announced, a lot of selling pressure. And then shortly thereafter, a lot of buying, putting price upward pressure. And that's a lot of trading volumes, and CIBC capital market divisions did quite well because of that.
Right, profit up about 20% in the capital market segment. But what we've heard over the years is that that's a volatile stream of profit and profit growth for the banks. It's not one that's easily duplicated, as is profit in personal and commercial banking. And so banks often don't get so-called credit for that type of earnings beat. Is that the way you view it?
And we see that today. It's relatively flat today, even though it was an impressive beat. Yes, that's not an inconsistent driver of revenues. But at CIBC over the last couple of years, I think they really rightened the ship, and they have a lot of organic growth that can continue the growth story going forward.
What kind of exposure does Caldwell have for its clients in Canadian bank stocks, keeping in mind that clients are different? Generally speaking, what kind of exposure do you recommend?
Yeah, for clients that need some dividend income, you'll see CIBC as part of our dividend strategy, focusing just on Canadian dividends. We have a good allocation to the banks there. And for clients who are looking for more of a growth story, more of our core portfolio, you'll find RBC there. Not necessarily a dividend play on RBC, more of a growth story, but CIBC is more of a dividend play for our clients.
And are you still buyers of the banks at these share prices after a big run over the past 5 or 6 weeks?
Well, again, 3% down today is a great buying opportunity. Both CIBC and Royal Bank have hit their highs previously to today. So yes, we continue to think that the growth story is there. What I did want to mention about Royal Bank is the HSBC merger. And when a merger happens right away, there's cost savings. Like, you don't need 2 trading platforms to save the cost of one.
Right.
But it's the revenue side, the increased revenue side, that by the end of 2027 fiscal, potentially $300 million could be added to the bottom line because of that merger.
Yeah, profit in Royal's Canadian personal and commercial banking business up substantially, largely but not exclusively because of HSBC. It did break out the difference. There were healthy gains in either way. I think it was a double-digit gain when HSBC Canada was included. I think it was maybe an 8% gain when HSBC was excluded.
Yeah, and there's a growth story right there.
Tony, thanks for coming in.
Thank you, Paul.
Tony Sierra, Vice President and Senior Portfolio Manager at Caldwell Securities. Coming up,